If we want to buy, we always buy at the demand. If we want to sell, we always sell at the supply. Now, if we sell at the supply, where do we take our profit? At the demand. If we buy at the demand, we take profit at the supply. Right? So you know already exactly where to take profit. Because now supply, when we have more selling than buying, we are going to see the price start turning downwards. Right? A price move down due to more seller than the buyer. Right? This is called imbalance between the buyer and the seller. Right? Price ranging, price trading in a range before the price drop, we call that as a supply. Know that is a supply. When the price revisit the supply in the future, we want to sell there. Okay? Example, price ranging. You can see this is price ranging. Before the price drop, right? This is called supply. Okay? Now, many people say that, well, Benny, how can I know that this is a big institution people are selling there? Very simple. Now, we ask ourselves, when people like us, retail trader, if we go and sell here, so much, it's impossible, right? Now, we look at this big red candle, right? The reason why we have a big red candle over there is because there must be some news event that trigger this action. After the news hit the market, there are some trader, especially the big institution, they see that this news is bearish. They start selling big, and so when the sell order comes in, and over here there's not many buyer, then what we're going to see is we are going to see this kind of big candle. It come down very fast. Why? Because the market is looking for buyer for all this seller, and the price will continue to go down so long as there's not enough buyer to fulfill the seller. We are going to see this price continue to go down. Another thing is, when we see such a big red candle, it tells us a lot of things. Besides telling us there's a big imbalance between the seller and buyer, another important thing is they tell us that origin of this range, you have a lot seller. As the price coming down, there's not enough buyer. There's a huge imbalance, right? Therefore, we produce a big candle. And over here, the body of the candle is all empty. There's not many order volume there. Because why? Because the price moves so fast. By the time the price from here, by the time the trader realize that, turn around, they want to put in order, the market already moved down. Therefore, you can see that all this, because the speed of the price moved down so fast, they left behind are all the vacuum gaps where there's not much order there. So in future, when the price start moving back up, because there's not much order, not much sell order there, it will fill up. It will come all the way up and stop where? Stop at the origin of the break. Means the bulk order is here. The body is empty. Now, if the body is empty, right, once the price come to this level and there are buyer at this level, buyer do not want to buy high, buyer want to buy low, right? So as the price drop until a certain level, when buyer think that it's time for them, it's fair for them to buy, they come in to buy. When they come in to buy, now we have about equal buyer, equal seller. You will see the price stop moving down. The price start to trade in this range, right? And once the buyer seller finish their transaction, finish their buy and sell, you see the market will just go up automatically because of the suction, because of there's not many buyer in this body here. The price will just move up higher. You stop where? You stop at the origin here. You will never stop anywhere on the body itself. So if you are a traditional technical trader, now a lot of people use moving average, using pivot point, using Fibonacci, right? And when they sell, let's say the price goes down, they sell anywhere there, they put their stop loss on the body, on this big order body. You realize that most of the time, your stop get taken out, and they will stop you out at the loss. Why? Because you put your stop where there's no volume. When there's no volume, obviously when the price starts moving higher, you get stop out. Then where's the volume? The volume is at the base, at the origin of the breakout. Right? Now I give you one example. Why we say that the volume are all centering here and not here. Now, example, if you want to sell a property, and the property that you want to sell is 1 million. Now, while you are negotiating with your buyer, suddenly there's a news, real estate collapse. From 1 million, which your initial selling price, the property price dropped very fast to 500,000. Would you sell at 500,000? Would you? No, exactly. If you have a holding power, say, I intend to sell 1 million. Now the market is crashed, only 500,000. I'm not going to sell. So what do? You hold back. You intend to sell only here. So, but the price already dropped to 500,000. So you do not want to sell. You say that in the future, when the price come back again, if the real estate price, property price recover to 1,900,000 to 1 million, then I come in to sell again. Does it make sense? So it's the same thing. If you are a big order trader, when the market already left this price, as a professional trader, you will not chase after the market and sell. Who will chase after the market and sell? Retail trader. Right? Retail trader, we're not interested because this retail trader tend to usually provide liquidity to the market. We are interested in the professional trader. How the professional trader react. If you are a professional trader, if you miss the boat, you say, I'm going to wait here. If I miss, I miss. I don't care. I wait for another round. Another round is when? Another round is when the price come back and you sell here. So for us is, once we identify the supply, right, this is a ranging. If the price come back in the future, we are going to sell anywhere here between the zone. Our stop loss is going to be above here. All right? Okay? So that is called the supply. The opposite of supply is demand, yeah? When the demand more than the supply, we are going to see a price moving reverse back up, right? Price move higher due to more buyer than a seller, we call that imbalance. The price ranging before the rally, we call that as a demand, right? So the opposite, we buy in the future when the price come back to the demand. So you can see the price ranging. When there's a news hit the market, traders start to enter the market and the price start to break, right? So what we do is wait for price come back in the future at this level here, in this two line, black line, we'll buy anywhere here. Stop loss below the black line. We call this L1, we call this L2. L1, L2. Right, just on the previous slide, L1, L2. L1 is always the line that is nearer to the current price. We always look to enter our trade on L1. You can put a pending order there. If you are looking to sell, you put a sell limit there. So your stop loss is always above your L2 if you are selling. If you are buying, I will put a buy limit on L1. Our stop loss is always below the L2. Are you okay? Yes.